Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Dick Matthews and then also Michael Brown of TraderX. Gentlemen, how are you doing today?
Very good, mate. It's very warm in London, hence the lack of ties. But yeah, I think we're pretty good, aren't we?
Birthday boy today.
This
Really?
is
Happy
yes.
birthday. Happy birthday to you, Mr. Brown. I
Thank you, mate. I know 61 today.
You're 61. You know, you're the first I think you're the first 28-year-old person I've seen in a 61-year-old mind ever.
28.
28. 28. Sold. Off and over.
I'll take it. All right. Well, shoot, if anybody called me 28, I'd be super happy about that. Anyway, well, happy birthday, Mr. Brown. I hope you guys are doing something more exciting than waiting for CPI all night tonight. You know, hopefully you're going to get out and have a couple pints together, being that you both are together. But let's talk about this. We have CPI tomorrow. How big of a deal is it here in the US? I know it here for everybody globally, for the FX market, for the markets in general. How important is the CPI data tomorrow? Let's start with you, Dick. What do you think?
I'm not sure it is that important, actually, unless it comes in really, really soft. I think it'll be a good figure, but I don't think it'll be soft enough to stop the Fed hiking on the 26th of July.
Yes, I think that's right.
My dates are right. I think they're going to hike again. And unless it's a really astonishing figure, I don't think that will stop them. The core's still too high. You know, there's still a problem, there's still an inflationary problem. And I think the central banks are almost obsessive with it now, as they were obsessed with it's transitory. They're now getting overly obsessed with inflation.
Well, you've lived through the 70s and 80s. I mean, I was around, but I was just
the 60s and the 50s and 40s.
No.
But do you remember the inflationary shock? I was a little too young at that time to really care, other than the fact that I was stuck in a gas station line with my parents. But you know, through those periods of inflation, being in the markets, I mean, it you know, central banks did make the mistake of, you know, trying to adjust rates or bring them down before the job was done. I mean, you know, do you think central banks, specifically the Fed, or maybe other central banks too, with the Bank of England, European Central Bank, that are still...
We just don't even go near the Bank of England at this time of day. Yes.
Okay.
I think that if you look back historically, the 70s and 80s, the periods of inflation there, they didn't peak and then just drop and flatline. They peaked, trough, went back up, dropped again and went back up. So you had 2 or 3 spikes of inflation before they leveled off. And you could almost argue that the 70s rolled into the 80s. It took ages to get it under control. And I've been saying for a long time now that these rates are going to stay high for a long time. You know, we were just talking earlier. When do you see the first Fed cut? A year?
I mean, well, I said to you earlier at lunch, you know, the earliest, if everything goes, you know, cataclysmically wrong, the earliest I would imagine the Fed would cut would be kind of June, July next year.
Yeah.
You know, we're 12, 13 months out at least.
Another couple of hikes before that.
Yeah, yeah, definitely.
Okay, well, you know, you're talking about them being laser focused, but is it you know, is it appropriate based on what we know about inflationary pressures at these, you know, what we've seen, this shock? You know, isn't it appropriate for central banks to be that way?
Yes, it is. I mean, the thing with, you know, so just to go back to your very first question, is the US CPI going to actually matter? No, it's not. You know, whether it comes in at 3.1 where markets expect, or 2.9 or 2.7, couldn't care less. Look at the month-on-month number, because that's all that matters. The year-on-year data is just so distorted by the ridiculously high prints we had in summer 2022, but it's not really worth the paper that it's written on. If you start to then annualize the month-on-month data, and particularly the core data, and Chair Powell said this at his press conference about a month ago in June, very little progress has actually been made on bringing underlying and core inflationary pressures under control. And all the time you're getting pretty resilient economic data. You know, you look last week, the ISM services PMI was pretty good. The job openings number was pretty decent. Yeah, non-farm payrolls missed by 20K, but that's a rounding error, let's be honest. You know, everything is still, and the housing market is starting to bounce back a little bit. Everything is still kind of ticking along okay. And all the time that the growth side of the equation is doing all right, and there's not a lot of progress being made on inflation, the Fed are just going to continue tightening policy. And even when they get to the point where they say, look, we're probably done, we're going to hold rates at this level, they're not going to then cut a meeting or two meetings later. You know, that's a 9-12 month process to go from terminal to the first cut, you would imagine. You know, so I don't think this week's inflation number is any sort of a game changer. And when you really start to dig into the data, there are very, very intense inflationary pressures under the surface, not least coming from the earnings component of the jobs report.
Sure. Now, but let me as you said, the earnings portion of the jobs report. I mean, that this is the Fed, you know, trying to wrangle in inflation, and they're having a very difficult time because the economy here in the U.S. anyway hasn't really slowed to a point where it's impacting it's not allowing for inflation to continue to moderate. But I want to ask you guys, and I'm gonna go here with you, Michael. Let's start with you first. Where do you stand moving forward? Do you think we're in a disinflationary environment that is going to continue to weaken? Do you think the Fed has it under control, or do you think that inflation is going to be rather sticky and we might see another ramp higher in inflation for one reason or another? Where do you stand on that? Because I think that's where the two camps diverge. Is where we're at. We're at that pivotal area, and there's deflationists. Is this deflationary hysterias? I don't know. And then inflationists and which way do you think?
Well, I just really appreciate, Blake, how I come on once a month and you give me the really easy, simple questions to answer. I think that's really nice of you. No, in all seriousness, I'd probably sit somewhere between the two, to be honest, and it depends which inflation gauge you look at. And this is why you've got two camps, because you've got data which validates both points of view. Because if you look at headline inflation, of course it's going to come lower. Energy prices are lower, food prices are coming lower, and you've got that base effect from last year that I mentioned. In fact, it would be staggering if headline inflation was coming in higher year on year, just because of the statistical way that it's calculated. And that's why I think, traders need to look past that and actually think, what are the Fed looking at? And the Fed have told us very clearly they're looking at two things. One is they're looking at core inflation. The second thing is they're looking at what some people are calling super core inflation, which is basically where is inflation in the services sector once you strip out the impact of housing. And when you look at that, as I just said, there's very little progress being made. And I think this comes back to a point that I'm sure you've made, Dick, and I think I made it last year as well, where, where did US inflation peak? 8-9%, something like that? I don't think we got into double digits, did we? Getting from 8 to 3 is easy because you've got all these quirks in the data that are just going to bring you lower. Getting from 3 to 2, which is, remember, where the Fed target inflation to be, is going to be infinitely harder than it was to bring inflation lower from that peak that we saw last year. And I think this is where you start to see a bit of a mispricing in markets, whether you look at the dollar or whether you look at rates markets, where, we're still seeing cuts priced in the first half of next year. But actually, are we going to see inflation at 2% in the first half of next year? I wouldn't bet on it. And I think that's where you start to see a little bit of an opportunity begin to emerge.
No, okay. Well, that's a fair answer, and I'm glad you eloquently answered that very easy question that I gave you. Dick, what do you think? Which way do you stand as far as inflation goes?
Well, Dick thinks inflation is going to stay high forever, and the Fed are going to stay at 7%.
No. I don't. I agree with what's that called? Malcolm. Michael. Who's Malcolm? Who's Malcolm? Who's Malcolm when he's around? I don't know who Malcolm is. The one thing that not concerns me, is I'm interested in is how money supply is dropping. And it's dropping really, really rapidly and has been doing so, which is always disinflationary. I remember, and before I get kicked for saying, when we were just obsessed in the markets watching money supply, it's the only figure we watched on these come out on Thursday or Friday night, and we would just wait for that figure to come out.
Oh, the city was wild.
The city was wild in those days. We didn't care about non-farm payrolls or anything like that. Money supply was the big number, and I think that's dropping very rapidly, and no one's really picking up on that. It's the same as happening over here and the same in Europe. So I think that's interesting from the disinflationary side. The inflationary side, again, we obviously had lunch together today. Do you think that Putin will be able to resist squeezing energy prices over winter? I don't think he will. I think there's a real good reason for him to squeeze energy prices. Same with the Saudis, the same with Iran. Basically, I'm going to get killed for saying it's the anti-American factor in the world. I can see them really squeezing energy, and that to me will be inflationary. So that's on the other side of my worry. So I'm actually negating each argument here very cleverly. That's I think it's really, really at a junction, but I still think the Fed will hold rates high for a long time.
Okay, well let's shift gears a little bit to your favorite bank of the BOC. I mean the BOE.
I'll see you around.
Yeah. So we've got the sterling. We've got the sterling that continues to rally, and this seems like to me that it is. I mean, once we broke through that 126 level, it's been choppy, but the cable's held up really well. I mean, this seems like the market's calling the Bank of England's bluff, saying that Bailey's going to have to put on his big boy pants and keep raising rates aggressively or more aggressively. What are your thoughts on the sterling at these levels as we trade above closer to 130? How about let's start with you, Michael. Where do you stand with the cable?
Sell the hell out of it.
Sell the hell out of it.
Yeah, I mean it's ridiculous. It's got to the point where UK rates markets have just gone into almost kind of capitulation mode. What is it now? Terminals priced at 6.6-ish%. I think when you look at the IS curve going out to kind of March, April next year, they're not going to get there. They're just not going to get there. Even if they raise rates, they surprised in June with a 50 basis point hike. It surprised me. I think it surprised probably everyone apart from Dick. Even if they continue to raise rates at 50 basis point installments, you're then saying they're going to hike through to November. No chance. The economy is going to go south a long time before then. We've got a real problem in the UK with mortgage refinancing. We've got a lot of people who have fixed rate mortgage deals at somewhere below 2.5%, and these are pretty much all coming up to maturity and to be remortgaged between about now and the end of next year. And that is going to have a real impact. You're seeing people's mortgage costs double or even triple overnight just because of the impact of the move higher in rates. That's going to have an impact on the housing market, which is either going to see prices fall considerably or just entirely seize up. It's also going to have an impact on disposable income. People are going to be spending 3 times more on their mortgage. They're not going to be going out for beers every Friday. They're not going to be going out for a meal with their family or to the cinema at the weekend or whatever it may be. I think the problem that the Bank of England have got is now a credibility issue. And I can talk about this all night. I'm not going to, but the issue they've got is because they let inflation get so far out of control, almost 5.5 times their target, they now can't sit there and go, we're seeing signs of fragility come through in the housing market. Unemployment is starting to rise. We expect inflation to come lower. So we're going to sit on the sidelines and we're going to hold rates. They don't have that luxury anymore. And I think markets know that. And I think that's why we've seen, this dramatic hawkish repricing. But cable trading at 129, when you've got persistently high inflation, ridiculously anemic economic growth, and a BOE that it has almost no chance of living up to the expectations that the market has priced in, it just boggles the mind, to be quite honest.
So where did they go wrong? I mean, did they go wrong, Dick?
Oh,
when
don't
they,
ask that. We'll be until about 11 o'clock.
I love it. I love it. So do our viewers. As a matter of fact, if you have something to say and you're listening in right now, jump in the comments below and tell Dick and Mike how you feel about the Bank of England. But
to me,
Richard, but what do you think? Where did they go wrong? Where did they go wrong?
Three ways they went wrong. They appointed Andrew Bailey as governor, who is a office worker.
Yeah.
You know, he's not a banker. He doesn't understand markets. He's absolutely out of his depth. Quite honestly, he should have been fired by the FCA. You know, there was a scandal there.
I mean, you bring a bloke in who made an absolute pig's ear of his last job at the FCA. You know, you ask anyone in the markets, Andrew Bailey at the FCA was a nightmare from start to finish. You give him the most important monetary policy job in the land. What do you think is going to happen?
And then they rule by groupthink. There's not one independent thinker since Andy Haldane went. Who both of us are very critical of him, but you know, he had a different approach and a different idea. The MPC, Monetary Policy Committee at the moment, all think the same, you know, which is ludicrous. There's no thought process there whatsoever. The government does absolutely nothing. So you tighten monetary policy, they give it away in the other way by, you know, making changes to mortgages so people aren't hurt so much. Well, you're actually undoing everything that the Bank of England does. They do nothing to fiscal policy to help the economy, and they have got themselves in a position where the markets, you know, like we both think, have no respect for the Bank of England anymore, which is a very sad thing for me to see and to say. They were forced into the last hike, I think, politically. I think they're going to be forced into another hike now. And actually, they probably should just be stepping back and waiting. You know, wages that came out today were very, very high, but they're miles behind inflation data. I think they boxed themselves in. And finally, they were the first to hike rates, I think, out of all the major central banks. And then they just sat there twiddling their thumbs and weren't aggressive. And they let it go. And they've been playing catch up.
And that was probably their biggest mistake. Right.
The earnings figures, I think I'm going to call into the ONS with a bit of a steward's inquiry on those. I mean, if you look at the breakdown, and actually there is an important point here, the breakdown of the earnings growth that we're seeing in the UK, it is very much concentrated among what you would typically consider higher earning sectors and professions.
Right.
You know, I was going to say that, you know, according to the ONS, wages in the finance sector rose 9% year on year, and you know, I'm happy to feed back my anecdotal evidence which disproves that fact.
Ask Chris Weston.
well, we're going to get back to Chris Weston on that one. Let me ask you guys this as we try to wrap things up. I want to talk about where equity markets are globally. I mean, we just saw the DAX hit all-time highs. We had the S&P. It's not too far off of its, you know, well, it's near 2023 highs. And, you know, NASDAQ continues to be relatively strong. I mean, you got your great 8 or magnificent 7 or whatever you want to call whatever stocks that are really outperforming. But overall, equity markets look pretty good considering this move that we've seen in yields. We've seen yields just scream higher globally, minus Japan, and a couple other countries, but for the most part, we've seen yields move higher. Is that sustainable? And how do you feel about the bond markets just in general? And let's start with you, Richard. You've been around long enough. You obviously, you know, have a sense. Sorry, that was not a dig, but you know, since it's Michael's birthday, that was a birthday gift to Michael. So happy birthday for taking that dig. But Richard, what do you think about the bond market, where we stand, and how are yields going to affect global markets in general?
I was just trying to think of something clever to say about Michael's birthday, because actually,
where's this going?
I'm just trying to work out the numbers. He actually his age is half the time I've been in the market.
Oh God!
And I was trying to work out how to come out with that cleverly. I was very interested to see that the 10-year US bond market is on a voodoo line, which I have no idea what a voodoo line is.
What?
Yeah, voodoo chart line. I don't know what that means. And
I don't know either. I'm gonna,
yeah, so
not sure.
There's a friend in Chicago saying that, and it's going to rally like no one's business. Having said the famous last words, it probably will. Follow the bonds. I'd always follow bonds, not equities. I've been saying for ages, I don't understand why equities up here. I just do not get it. And I think you'll get a day of reckoning. God knows when you'll get it. I just think that they're ridiculously high. And maybe people suddenly start saying recession is coming, which we've been looking for ages. Earnings are going to be poor, you know. But it's driven by, what, 7 or 8 stocks. You know, that's all you're punting. You're not really trading a wide sector.
Well, Michael, with this, you know, there's definitely an excessive or heavy bearish sentiment in U.S. Treasuries anyway. But with yields at current levels, I mean, do you think bonds are going to be more attractive near these levels for asset managers globally? What do you think?
Well, this is the thing. I mean, yeah, and this is the question that, as you say, asset managers are going to be asking themselves, because you look at all the surveys that, you know, all the sell side put out, and everything says there's a lot of cash still on the sidelines. So the question is, where does it go? Does it go to bonds, or does it go to the equity market? I mean, I would still argue the bulk of that will go into equities. I mean, you're dealing with a market where the VIX is what, 13, 14? I haven't got a screen in front of me at this point, but you know, it's around that level.
15, yeah.
You know, it's very, very tough to be bearish on equities over the medium term when you've got volatility so low, volume's pretty thin as well, of course, going into summer, and also this amount of cash just sitting there waiting to be put to work. And I think the other thing you've got to remember, and I think we saw a bit of this impact going into the end of the first half of the year, is if you're producing a statement or a half-year report or a letter to your fund, and you're saying, we're not invested in NVIDIA, or we're not invested in Meta or Google, or one of these magnificent 7 that you mentioned, it's a bloody tough job to justify to your, you know, the people who are invested in your fund, why you do not have at least some exposure to those firms. So I think as long as that is still the case, I think we're going to see equities move higher. And you know, I know Dick mentioned recession. I know you mentioned the fact that yields are moving higher. But how much of this is discounted? I mean, we came into 2023 going, by the end of the first half of the year, we're going to be in recession. You know, the Eurozone is going to bear the brunt of it. The UK is going to be absolutely stuffed, and rates are going to be cut. But none of that's happened.
And rates are still going up.
And the equity market's still going up.
Still going up. It's
yeah.
Just, you know,
so
to me, it's bizarre.
Yeah, I just kind of sit here going, you know, always the path of least resistance for equities is higher. You know, history proves that over 70, 80 years. So to bet against that, you've got to kind of ask yourself, what's the catalyst for us to move lower? I don't really see one at the moment, unless we see disastrous earnings from the tech firms, which are due out in a couple of weeks. I'd be happy to be buying into any dips that may occur.
All right. Well, we're going to leave it at that, since it is your birthday, and I want you to both be able to go enjoy a pint. And I wish I could be having one with you.
But he doesn't drink.
I don't drink, so yes,
well, Michael, I'll have one with you, and he can have his iced tea. But
he can carry me out the pub.
Right, there we go. But I want to say, it's great meeting with you gentlemen, and you know, I'm glad that we get to do this once a month. But before I let you all go, I do want to say to the folks listening in, make sure you jump in those comments, give them a thumbs up. Michael, what's the best way for us to follow you and your work?
Oh, I'm not sure you'd want to, but traderx.com, we post a few videos there, and Mr. M. Brown on Twitter. Well, if Twitter works, that is.
Yeah, that is if it works. All right. So, Mr. Matthews?
You can find me actually on TraderX as well.
Oh, you can.
I do make a guest appearance every now and again, and get
we scrape the barrel.
They got no one else on there. Give me a wooden spoon for coming last, or at Dickie Matthews on Twitter.
Great. Well, you know, and by the way, I'm looking forward to the trade-off show. I haven't got a chance to sit down and listen to it, but I'll be listening to it this evening. And you guys always do a great job with that, Mike. And Richard, I'll be seeing you in just a few days.
Good stuff.
All right. Thank you,
Clearly, I
gentlemen, for
haven't got an
joining us.
No, you haven't got an invite. This is for senior brokers only. No juniors allowed. Past your bedtime when we do it.
Intern seasons.
Intern seasons, yeah.
Having these two guys together. What can I say? All right. Thank you, gentlemen, for joining me. I'll see you guys in the next few weeks.
No, thank you, mate.
Cheers,
Pleasure as always.
Cheers. Bye.
Cheers.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.